March 2023, a payoff statement lands on a kitchen table. It says one wire transfer ends the mortgage. The bank never mentions the number underneath. 2.65%. 2.65. The cheapest mortgage money in 50 years of data. Marcus and Dana wrote that check. Those are not their real names. This is a composite built from IRS, census, and CFPB records. Details are changed. They followed every rule, paid on time, refinanced low. They believed the system was on their side. The letter looked like freedom. The math says otherwise. By the end, you will know exactly what your mortgage is worth. And when paying early is the costliest gift you can give a lender. Everything in this video comes from public records. Freddie Mac's weekly rate survey, IRS and Tax Policy Center tax data, FDIC banking reports, New York Fed household debt numbers, CFPB mortgage complaints. Every figure can be checked. Nothing here is rumor dressed as fact. You will learn 3 things: how your rate was set, who profits when you prepay, and the 5 checks to run first. You will leave with 1 number to find on your statement and 3 documents you can request this week. That is the promise. The records are public. The pattern is documented. Meet the couple at the kitchen table again. In 2021, they refinanced their Dallas suburban home at 2.65%. That was the lowest reading in Freddie Mac's survey, which dates to 1971. The balance? $187,000. 25 years remained. By March 2023, the cash was ready. A bonus, an inheritance, savings. The math seemed obvious to them. The rate was 2.65%. The cash sat idle, earning almost nothing. Their plan had one flaw: the rate they were giving up. The payoff statement arrived, and they wired. The keys felt heavier that day. The celebration was real. No more payment, no more bank. "We own it," they told their friends. 12 months later, the layoff came. Dana's employer got her position. The HVAC died that month, then the roof. They needed cash, not equity. So they went back to the bank they had just paid off. The answer was a HELOC, a home equity line of credit against the house they now owned outright. In early 2024, the average HELOC rate was above 10%. They repaid 2.65% money. The new loan cost nearly 4 times more. The same bank, the same house, the same family, and a worse deal the moment they did everything right. They could not understand why finishing first earned a loan at 10%. Here is the machine. Now follow one single dollar. Your extra cash goes to the servicer, the company that collects your payment. The servicer keeps about 25 basis points as its yearly fee. That's 0.25% of the balance each year.
A basis point is 1/100th of a percentage point. The rest goes to whoever owns your loan. Most mortgages are not owned by your bank. Lenders bundle them into mortgage-backed securities, bonds made of thousands of home loans. A pension fund in Tokyo can own a slice of a Dallas roof. Your rate was never set by a loan officer in a branch. The bond market set it. 10-year Treasury yield plus a spread investors demand, and it is held down by a quiet federal guarantee. Fannie Mae and Freddie Mac, government-backed companies, buy most new mortgages. The Congressional Budget Office has documented this backstop lowers your rate. Who gets paid when you prepay? The investor does. So who makes the decision? You do. That is the strange part. You hold one of the only free options in American finance. The Dodd-Frank Act banned prepayment penalties on virtually all mortgages. Your loan contract lets you prepay anytime, penalty-free. You can keep a 2.65% loan for 30 years or walk away anytime, free of charge, with no penalty. Paying off early is the one decision you make alone. It is the one that cannot be undone. Who carries the risk after you pay? You do. All of it. Now, the incentives. In 2021, a 2.65% loan was gold. In 2026, that same loan is a burden. Today's 30-year rate, 6.66%. When you prepay, the investor gets cash back. He lends it out at today's higher rates. Your discipline finances their upgrade. The FDIC counted $620 billion in unrealized losses. That was bank securities at the end of 2022. Paper losses from old low-rate assets in a high-rate world. Silicon Valley Bank held $117 billion in bonds, $15 billion underwater. In one day, depositors requested $42 billion. Bank failed within days. The lesson isn't about startups, it is about cash locked at yesterday's rate. A paid-off house is the personal version of that lock. Scale. American mortgages total about $13 trillion, and it's growing. 40% of owner-occupied homes are already mortgage-free, the highest share on record. Among owners over 65, it's 64%. The share has climbed almost every year since 2010. The mortgage-free club keeps growing. Here's the tax twist. The 2017 tax law doubled the standard deduction. Itemizers fell from 31% under 10%. Millions of households no longer get the mortgage interest deduction at all. The old reason to keep the loan, the write-off, is gone for many. The old reason to pay it off, the feeling of freedom, is expensive. What does the industry say? Lenders call prepayment a personal choice. Legally, it is. Regulation Z requires a payoff statement within 7 days. The CFPB holds complaints about payoff balances and lien releases that never arrive. The counter-argument is genuine.
Prepaying at 6.66% gives a guaranteed near 7% return. That beats bonds. Retirees with pensions have good reasons. So do savers who would spend the cash and borrowers paying mortgage insurance. The problem is not the tool. It is using it at 2.65%. Here's what the records show. The real issue is not the final payment. It is that your mortgage is a subsidized, inflation-eating loan. The market cannot replace it. In June 2022, inflation hit 9.1%. Your 2.65% loan was shrinking. Inflation ate the dollars you owed. In real terms, the lender was paying you to borrow. Prepaying turns the cheapest money in America into your least liquid asset. It hands the lender's asset back when higher rates make it worth repricing. The bank never calls to say thank you. That is the tell. Today, that rate costs more than twice as much. The law leans that way too. The Richmond Fed counts 11 states. California is one of them. Lenders cannot chase borrowers after foreclosure. The federal bankruptcy exemption? $31,575 of home equity, and it caps equity from homes bought 40 months before filing. The cap is $214,000. The invisible control. In many states, equity you think is safe is reachable, unless a mortgage lien guards it. You can refinance later. You cannot unpay a loan. Here's the only thing I will ask. Know someone about to pay off their lender? Send them this video first. Now, the protection. First, find your rate and your remaining balance. Compare them to today's rates. A new mortgage costs 6.66%. A HELOC costs about 7.4%. Borrowing it back is not cheap. If your rate is far below today's costs, prepaying is a gift, not a gain. Second, request a written payoff statement before wiring anything. Verify the per diem interest and the exact payoff date. Per diem means per day. The interest accrues daily. Servicers must answer payoff errors within 30 days. Use that right. Third, run the 5-year liquidity test on your cash. If a layoff could force you to borrow, stay liquid. The house waits. Fourth, if you still pay off, get the satisfaction of mortgage. The satisfaction document proves the lien is released. Confirm it is recorded at the county recorder's office. Keep the payoff statement forever. Servicing errors are documented. Your paper is your proof. Fifth, buy 1 hour with a fee-only planner before retirement or estate planning. Weak exemptions make that hour cheap insurance. It is the cheapest protection in this video. That's the whole checklist. That payoff letter from March 2023, it sits in a drawer now. Once your receipt for freedom. Marcus rereads it sometimes. The numbers are still there. Now you know it can be a receipt for a returned subsidy. Marcus and Dana still pay the HELOC today. They still ask why nobody told them the price of doing everything right. The question is not whether the system can see your balance. It is whether you can see the decision before it arrives. Next week, the satellite images your home insurer already bought and how an algorithm prices your roof from the sky.